Today, break the economy or break the economy? Hello again, it's Martin North from Digital Finance Analytics, web notice post covering finance and property news with a distinctively Australian flavour. Friday afternoon, and Tarric's with me. Hi, Tarric.
G'day, Martin. Welcome to the show.
Thank you very much. Good to see you back again. And oh dear, you know what we're going to say? There's a lot to talk about.
Well, there certainly is, isn't there? We've got disappointing US GDP data. The discussions of a potential US recession already on the horizon, and then you've got the plummeting Japanese yen. You've got lockdowns in China. You've got war in Ukraine, and there's more than we could possibly get through in our hour-long chat.
Yes, don't mention the interest rate rises, and don't mention the GDP, right?
All the inflation print here in Australia. 5.1%.
I know.
Shocking everyone into action.
I know. It really is interesting, actually, watching the press coverage, right? Because there's been suddenly a lot of realization that actually rates could go up. I mean, they should have been listening to our shows, Tarric. We've been talking about this for an awful long time.
Well, we have, and to be completely fair, I mean, honestly, I wasn't sure that the RBA would ever be shocked into action. The way they just feel comfortable sitting on their hands doing absolutely nothing. But it seems now that, I mean, there's been some fairly forceful words from some economists and, even from the big banks. They said, like, the ANZ came out after this week's inflation data and said that it's entirely inappropriate that we should have a 0.1% cash rate. And those are some pretty strong words. And I guess in fairness, the banks are experiencing some pretty major funding pressures at the moment as their costs rise, and they want to pass them on to the consumers in a, shall we say, palatable way through, official cash rate increases.
Yes, well, clearly the margin pressure is there. You look at all the recent results, and the banks are in a bit of a bind because that really cheap money from the RBA is having to be replaced at some point. Going to the cash markets internationally, they're having to pay a lot more already. And as you say, from a PR perspective, if they start putting out of cycle variable rates up, that's going to create a significant mayhem, particularly around the election. But it's worth noting that the fixed rates just keep going higher and higher and higher. So they are finding a backdoor route. And interestingly, of course, what they keep doing is outsourcing the market risk to the variable rate borrowers who are still being teased with relatively low rates.
Well, they are, aren't they? I mean, and these variable rates are not really all that sustainable. You look at say something like the bank bill swap rate. The rates for interbank lending, and you do the math on that. You put it together with the bank's average net interest margin, and all of a sudden you just look at it and you go, this is completely unsustainable. These rates are going to have to rise, particularly as the RBA, as the banks are forced to finance the RBA's TFF support, which means they're going to have to come up with $189 billion from the markets. So, it's going to be it's a lot more expensive than the 0.1% they're paying now.
Exactly. And I will just make the note here that, the RBA, when they were in front of the Senate recently, expressed some surprise about how things are changing and how they have to change their views. They do seem to be on the back foot.
Well, they're not unique in that regard. I mean, you look around the world. You look at the European Central Bank. You look at the Fed. You look at especially the Bank of Japan. They've all built themselves a house of cards, and now the house of cards is falling to bits, they're all looking rather silly. And in that, the RBA is no different. And it's going to be really interesting to see exactly how much they flip the narrative and they flip hawkish, as the Fed has done, and as even the ECB is starting to look a little bit more hawkish, at least in terms of their rhetoric.
Well, the old parable about the emperor has no clothes. Well, a few people are being saying, hang on a moment, just what are they wearing?
Well, exactly. I mean, you're seeing that particularly in Japan with, the Japanese yield curve control butting up against reality. They're trying to cap bond yields at a certain level, and then people don't want to buy them at that level. So you're seeing these capital outflows. You're seeing the depreciation of the Japanese yen against the US dollar, and well, that could cause some really interesting, shall we say, movements in the markets, and things that impact Australia as well.
Yes, well, I understand that the Fed is quietly supporting the yen at the moment, through the back door to try and...
Oh, I'd be astounded if they weren't,
Absolutely. We know they are.
Oh, yeah, there's probably swap lines and all sorts of things going on behind the scenes for them to support them. But I think the really interesting thing is that I feel like it's this battle between reality and central bank narrative. And the Fed knows that if the Japanese central bank narrative blows up, as a major central bank, the third largest economy in the world, if their narrative blows up, there's every chance the Fed's narrative, the Fed put and everything that goes along with it, could be threatened at the same time. So it is very much in their interests to protect that. And currently that's not working too well.
No. Well, of course, you can go on telling a story, but the further reality gets from the picture you're trying to paint, the more excuses you have to come up with, and eventually it just sort of falls flat on its face, doesn't it?
Well, I think we're actually going to see a really interesting battle go on in Japan, because on one hand, you've got the Japanese government, and in particular the finance minister, who came out the other day and basically said that these moves, to put it into a very, very, very short summation, that these moves for the yen are bad and disastrous, considering how swiftly they're occurring, and the devaluation is going to end up impacting households and businesses. But then you've got the BOJ and their leadership saying that we're going to keep doing what we're doing and doing what we're doing until kingdom come. So eventually they're going to clash.
Yep.
And eventually, in my view, the Bank of Japan is going to lose. And if they do abandon yield curve control, well, what happens then? The yields go to the moon. That's what happened here when the RBA abandoned yield curve control after the market kicked them square in the nuts.
Yeah, absolutely. And of course, you've got this other very interesting dynamic where the monetary settings in the US are pulling exactly the opposite direction from the monetary settings in Japan, right? In China, the two biggest economies in the world, also pulling in different directions. So once again, you can see these tensions really developing.
Yeah, and exactly, and we've seen that in recent days in the value of the Chinese yuan being hit. It's experienced its largest weekly hit relative to the US dollar since 2015, and that was amidst something of a crisis within the Chinese financial system. So, it's well and truly all happening. And to hark back to our last chat where we said the crisis has begun, the writing's on the wall and the proof is everywhere. All you've got to do is look at all these different indicators, and it's not looking good. And I will say one thing about even the US GDP data. Not even I expected a print that negative. I thought it might go a little bit negative, but it got hammered.
And it's interesting, just on the fall in the GDP, and there's a lot of narratives that say, well, these are one-offs, there'll be revisions later. But it's another sort of nail in the coffin of everything's wonderful. There are definitely some leading indicators. But never mind, the Fed is hunting inflation, right? And I guess we should probably go to your slides. And the first slide is just absolutely brilliant because it really beautifully sums it up, doesn't it?
Oh, I quite like it. It just sums up the ridiculousness of it all so well. And if anyone is looking for the slides, they are available at avidcom.substack.com. If anyone wants to buy me a beer for my efforts, you can do that at the website. So with no further ado, let's get started. Australian inflation, 5.1%. If you strip out the impact of the GST, which occurred in the early 2000s, that little peak there where it went a little over 6%, if you strip that out, we are seeing the highest inflation since the mid-1990s. Now, the introduction of the GST was a known quantity. Everybody knew that it would happen. Everybody knew that the prices would rise. But this is occurring at a time when people weren't expecting anywhere near this magnitude of inflation. And not only that, but real wages are going backwards at the fastest rate in decades. So it's, whatever way you put it, it's not a pretty picture for the Aussie economy in that regard.
No, absolutely. And it's worth just highlighting the fact that the 5.1, that's an average, but actually if you look at across the states, there's quite significant variations. And also the discretion versus non-discretional spending is different. So 6.6% for the stuff you have to buy. So what it basically says is, it's really painful out there for real households, which is precisely what my surveys have been saying for quite some time.
Yeah, exactly. And I've got that in the next grid, the next chart here. It shows that basically, if you're talking about discretionary retail, inflation's only 2.7%. It's actually technically within the RBA's target band. But if you look at non-discretionary inflation, as you say, it's running at 6.6%, which I think, just to take a little bit of a detour for a moment, makes the Morrison government's $250 cash payments to pensioners look a little bit ridiculous, because pensioners are heavily, their spending is heavily tilted towards non-discretionary items, things like fuel, things like housing, things like food, which are all rocketing along. And $250 is a drop in the ocean compared with the additional costs people are experiencing. But the truth is that, that's the same tack that they're taking around the world. They're trying to solve an inflation problem with more money, and and somehow I don't think that's going to work.
No, and the other point, of course, is those measures were very temporary measures, right? It's sort of bridging the election. It's not actually really solving the long-term problem. And a lot of this embedded inflation that we're seeing is going to continue for some long time. So the chances are we're not going to see things reversing anytime soon. And yet the government responses have been, well, more about winning the election than actually dealing with the real issues, in my view.
Well, it's interesting that you should mention the fact that these issues are going to become, that there's a long-term issues. Leaving aside the fact that we're going to see inflationary pressures from Ukraine, from the lockdowns in China, etc., and those are going to echo throughout the rest of the year and into next to varying degrees. There's also the issue of rents. Now, in the CPI, the ABS measured rents is only rising by 1%.
I know.
Now, according to CoreLogic, according to SQM, according to all these other data providers, you're talking about rents in capital cities rising to somewhere between 9 and I believe about 12%. So now, if we just assume, and we give the ABS the benefit of any doubt that there's just a lagging indicator, you're going to see major rental inflation continuing to flow through into the CPI for the next year, maybe the next 2 years, which is going to continue to put upward pressure on inflation and make the RBA's life more difficult. Now, considering rent is only at 1% now and inflation's already at 5%, what's inflation going to look like if it starts reflecting the rents of market rents from SQM, CoreLogic, etc.? It's not going to be a pretty picture, and we could see inflation well above the target band just on those things, without all the other shocks, without everything else, just on those types of inputs for quite some time, if it flows in. And I mean, let's just see what happens, shall we? I mean, it's the ABS. I don't know. I mean, Louis Christopher was asking some questions about that the other day of them on Twitter.
Well, this is interesting. Another factor, of course, in all of this inflation is the construction for new properties, which is more than 5% higher. Now, I just want to remind everybody that there was a reason why there was a big boom in construction, right? It was to do with home builder. It was to do with bringing first-time buyers forward and giving them, very significant incentives, and this new scheme where you only needed a few percent of a deposit. All of those were pulling stuff forward, which basically has stoked more building activity. So let's be clear, some of this inflation is directly related to government policy.
Absolutely, 100%. I mean, and I think it's disingenuous of the government to claim that they're not at all responsible for this, that it's all about the cash, all about the cash flashes overseas, all about the war in Ukraine or whatever other excuse they're coming up with. I mean, even if you just focus on the money given to companies that didn't need it, you're talking about tens and tens of billions of dollars that have flowed through into the economy, into new kitchens, jet skis, cars, holidays, you name it, that for people who didn't need it. And one, that's our tax dollars at work, and two, it's the fact that they've created all that extra inflationary pressure. I mean, if you look at, so like incomes in terms of the latest data, in terms of just incomes to households, they're about a little under $1 trillion a year, according to the latest data. Now, admittedly, that data is a couple of years old, and we don't have anything newer, unfortunately, but that's roughly ballpark. You throw an additional $40 billion on top of that through businesses to households, etc. Of course, that's going to have an inflationary impact. You've just thrown, an extra, what's that, 4.2% more cash at households, and that's not even beginning to get into the issues with equity withdrawals from people's mortgages, which is another $93 billion a year. So, I wonder why we have an inflation problem.
Well, maybe that $1 trillion of debt could have something to do with it, right? Because effectively the government debt is as higher than it's ever been. And the forward projections are that debt's going to be there for quite some time. So effectively, all of that investment, quote unquote, and I'll put big quotes around it, all that investment has gone into funny places, wrong places. It's gone to the big end of town. It's gone to things that it should never gone to. Just think what we could have achieved if we put the money in the right places.
Yeah, you could have built social housing for probably 200,000 people plus. We could have done all these wonderful things, but we didn't. We spent it on, and I think one of the interesting things is that they're not being held accountable for it. No one really cares, and that's really something. There is a subset of people, and I guarantee, probably more likely our people who are in our viewership, who care about these things, and but it's not really moving the needle elsewhere. You'd think people would be annoyed about it, but maybe they will be annoyed about it if the scenario in the chart on the right hand side comes to pass, which is the inflation that it's helped create and the interest rate rises that's going to drive.
Absolutely. Well, we'll see how it all plays out, but it certainly could be quite painful. And just going back to that slide that you put up, the other one is really important too, right? The cash rate priced in. So rate rises ahead.
Yep. Well, it's now a consensus call. So, they've caught up, and we're just going to have to see exactly how that evolves from this point onwards. But I mean, I really don't think that these scenarios can be ruled out, considering the issues with Ukraine, with China, and just the core issues we face here in Australia. I mean, really, it's just whether the RBA is going to have the bottle to do it or not.
Well, my view is if they don't do it in May, that'll prove that they are much more politically influenced than they should be. They should have done it last year. But if they do it in June, that shows you that they're going to wait until after the election, and then they can't feel that they can be blamed for any political interference. But it's another month gone by, and these have been building for some time. That's the point I think we should come back to, Tarric. There's no surprise here. Anybody who's been watching this economy for a little while should be absolutely under no illusion that rates were going to go up and inflation was going to go up.
Well, it's funny. Like I wrote an article back in January detailing how how a rate rise during the election could impact, Scott Morrison's chances, what the historical precedents were, and where the market was at the time. And now here we are. And it's like it was, there was that potential there the entire time, yet it was disregarded. I mean, you can come to your own conclusions as to why, hubris, whatever. But it's just interesting that now that's the consensus call. And I really do wonder how much that consensus call is going to evolve over the coming months. I mean, Goldman Sachs recently raised their year-end forecast for the Australian cash rate to 1.75%. Yep. And if that comes true, well, there are a lot of people who are going to have a problem.
Absolutely. Well, rates are on the way up. It's just a question of how quickly now.
Okay, now to China. Now, well, everyone knows there's the lockdowns going on in China at the moment. It's, well, to say it's challenging is a bit of an understatement. The number of flights currently going on in China is less than during the Lunar New Year and the initial lockdown in Wuhan. And you've got around about 40% of Chinese GDP in terms of the provinces and cities currently in lockdown. And China remains committed to COVID zero. While there are some promising signs somewhat in Shanghai today with a few million people being allowed out, there's still tens of millions or hundreds of millions, probably more, around China currently in lockdown. And that's not set to change. And I should also just point out that we're about 6 months from the Communist Party Congress in October. And at that time, Xi is going to basically be confirmed. Well, that's the theory, that he'll be confirmed as leader for life. Now, while there's speculation that they could shift the narrative on COVID away from COVID zero towards something else, that's going to be pretty challenging in a nation like China, especially when you're putting fences up around cities and around people's homes, to suddenly shift from that to you've all got to go back to work.
Yeah, and interesting, of course, the actual number of cases is still quite low, at least the officially reported number. So if you weigh up the number of cases versus the number of people locked down, it does seem very asymmetric.
Yeah, it does. But I mean, let's be honest. I mean, it's highly doubtful that the numbers are worth the paper that they're written on. So now, I think this chart sums it up beautifully. It's basically ships waiting to load or unload at the port of Shanghai, and if you look at the chart, it really just points out the severity of the situation. And this is only to the start of, sort of early to mid-April. So, the situation could have worsened significantly since then. And this is just going to echo throughout the world with more supply chain issues. And it's also the fact that this is going to butterfly out. You're going to end up with the backlogs at Shanghai, Ningbo, all these other impacted ports throughout China, spreading once again to places like LA, Long Beach, Rotterdam, etc., the big ports of the world, because these backlogs will eventually be cleared. And then you'll have all these ships all set off to their destinations. And then you're going to have more backlogs just like we had last year. To what degree is, an open question, but it just goes to show that the supply chain issues are not over, and they're not going to be over for quite some time.
And just to explain that chart, as I look at it now, what we're saying is that this year we're up to nearly 800. Is that right? Whereas last year it was 400.
Yeah.
Yep.
Exactly. And I mean, this includes the averages of 2 years of random lockdown as well. So it just goes to show how much that's just rocketed. I mean, there's a slide going around, of showing the number of ships that are around the port of Shanghai. The one that actually shows all the container ships, not the one that shows every ship. That's a bit preposterous, and it's just amazing. Now, one thing I think is really, really interesting is that, generally speaking, the commodity market moves as a whole. I mean, there are always things that move independently of it. There are always different supply and demand factors, but I think that it's possible that we could see a major bifurcation between most of the commodity market and the bulk minerals that China uses to drive its economy. Now, this chart shows the commodity prices against growth in Chinese imports year on year, and Chinese imports growth is basically flatlined. And traditionally, as the correlation in the chart shows, normally commodity prices follow. But that's not happening. Commodity prices are currently either at or near all-time highs, depending on which commodity you're talking about. But the question is, can that continue? With the Chinese government potentially spending all this money on supporting households, instead of throwing money at the property sector and the construction sector, as the consensus would suggest, if that money doesn't eventuate, if instead they're forced to prop up the economy because of the ongoing lockdowns, and potentially lockdowns all the way through to the Party Congress in October and beyond, you could see this bifurcation of the market happen, whereby bulk commodities like iron ore and coking coal, which heavily rely on Chinese demand to define their pricing, they could drop significantly, while things like, say, for example, aluminium or tin or lithium or something, or things that are more widely used and more widely in demand could continue to rise in price. So that's an interesting question, both for the world and particularly for Australia, considering that we don't really have a super diversified base in terms of the large scale commodity exports in that regard.
No, we're very much reliant on one market, aren't we? And so the question is, can you substitute and replace? The answer is probably not, actually. So we're a one-trick pony.
We are. So if the spending doesn't eventuate, and if the Chinese economy continues to worsen, it's going to be pretty hard for the market to continue to justify the prices that we're seeing now. And on that note, the internals within the Chinese steel market are not looking promising either. So it's going to be interesting to watch. This is what I was referring to previously, the weakening of the Chinese yuan. This is a chart of the past year, and basically it is losing value relative to the US dollar quite rapidly at the moment. And this is for several reasons. Obviously, there's the impact of lockdowns, etc. But there's also the fact that the spread since the financial crisis, generally speaking, Chinese bonds have paid a premium over American bonds of the same duration. Because, obviously, if you've got a choice between investing with a Chinese bond or an American bond, most people are going to choose the American bond because there's better protections, there's more transparency, etc. But that risk premium has evaporated in the last few months, and in some cases, it's reversed entirely. For example, a US 2-year government bond now pays a higher rate than a Chinese government bond of the same duration. So that's causing this weakening of the Chinese yuan. So there's some potential, interesting times ahead in that regard, because the Australian dollar can at times be significantly correlated with the yuan, and we've seen that in recent days with the Australian dollar dropping from, what was around about 76 cents down to as little as under 71, I believe it was yesterday.
Yeah, absolutely. And it's also worth noting that the net investment flows, which were until quite recently going into China, are now coming the other way because of that change in economics.
Yeah, exactly. And as the Chinese economy continues to deteriorate, if they do press on with the COVID zero strategy, we could see those outflows continue to accelerate. So it's gonna be a really interesting one, a really interesting little factor to watch. And I think that's one of the things that's somewhat underappreciated is, because there's, as we said at the start of the show, there's so much going on at the moment. I feel like this is almost flying under the radar a little bit.
Yeah, I did a show over the weekend talking precisely about the relationship between China and Australia, looking specifically at the trade relationships. And, China is one of our biggest exporters, but other of the interesting observation is that we get a lot of our stuff in way of imports coming in from China. And with all those trade disruptions and the movements in the exchange rates, the import side is going to be significantly under pressure. And I think that's something that people, again, are not actually understanding.
No, I don't think so either. This brings us to Europe. This is a nice little map from Bloomberg of the gas pipelines running from Russia into Europe. And in recent days, the Russians have cut off gas to the Bulgarians and to the Polish, who've both refused to pay their bills in rubles, as Moscow has demanded. So it's going to be very interesting to see how Europe deals with this, because there are some countries in Europe who want to continue to get Russian gas because they're reliant on it. They need it. Their economy, will struggle badly without it. While there are others who are taking a far different stance, either out of ideology or because of a sense of pragmatism, because they don't need it as badly as others. So it's going to be very interesting in that regard.
Yeah, absolutely. And it's worth just highlighting again that whilst that there a lot of European countries have been trying to reconfigure their pipelines so that they can sort of go two directions and go around some of the problem, there isn't overall enough supply in the whole system. So the more Russia turns down or turns off, the bigger the problem. And I noticed that Germany is still planning to pay in euros via an intermediate bank that gets converted to rubles so that the Russians can get rubles. So how does that work under these restrictive practices that are meant to be in place?
Indeed, there's loopholes that you could fit an LNG carrier through, but it's quite interesting, because the thing is, this isn't just a European problem; it's a global problem, because they want to kick the habit of Russian gas and Russian oil. But the problem is in order to do that, they need to buy their oil and buy their gas from someone else. So you've seen other countries get absolutely hammered by the rising cost of LNG as more of Europe tries to convert to LNG as much as they can with the existing infrastructure. So you've seen places like Pakistan get absolutely hammered because they're reliant on cheap LNG. You've seen blackouts because they haven't been able to run their power stations. You've seen massive interruptions to industrial production. And now you're seeing the Pakistani government paying absolutely through the nose at record prices for LNG cargoes. So while Europe is taking a principled stand against Russia, that's having some very, very major consequences throughout the world. And Pakistan isn't the only one. The Koreans are seeing the cost of their LNG rocket as well, and their cargoes, which even some they've already bought, be sold on to then be sent to Europe, so the Europeans can try and kick their Russian gas habits. So, that's really one of the big issues going forward, just that butterfly effect, because it's not just, we're going to get rid of Russian gas and A, B, C, D.
And of course, that means that local gas costs will go up here.
Yeah, well, exactly. That's going to be a problem that the whole world is going to face. And I mean, even say, for example, just talking about interruptions to products from Russia, the Russian ban on fertilizer has been going on for a while now. This even predates the war. And as I believe Russia is the largest exporter of fertilizer in the world. That's having some major impacts on the market. The fertilizer costs for Australian farmers have risen 19% in the first quarter. So we're all going to be feeling that at the supermarket and greengrocer checkout.
Absolutely. And the big choice for farmers is, do they use less fertilizer, which means reducing yields, or do they pay a lot more for the fertilizer if they can get it, which means passing the costs on through the supply chain into the supermarkets? Whichever way you look at it, another inflation driver just there sitting in front of you.
Indeed, and it's probably the worst inflation driver of them all, because it's the one thing, that, I mean, we can walk, we can take a bicycle, but we can't not eat.
Have to grow your local veggies.
Well, maybe people should contact Edwin. He might be able to help them out with some carrots. Well, this chart really just speaks for itself. German consumer confidence has basically been smashed into oblivion. There was an accompanying thing from from GfK, the people who conduct this particular survey, and it basically it was one of the most, I wouldn't call it pessimistic or negative. It was just one of the most dire things that I've ever read in a mainstream release, and it was basically just that the hope that Germany could swiftly recover from the pandemic is dead. And that's not something that these people that these kind of surveys really talk about. It's more just this usual sort of very abstract, usually often upbeat sorts of things, but instead it's just this is toast. And really, it's going to be very, very hard for the EU economy to avoid a recession.
And just to be clear, this is a lower read than at the worst of COVID right at the beginning in 2020, right? So this is pretty horrendous, and it's still going down.
Well, it's kind of crazy, because if you look at the lows of the financial crisis, it was about a 2 during the worst of the financial crisis, and now we're at minus 26.5. It's just broken the chart. I mean, since COVID, they've just had to completely resize the scale on this thing. And they're not alone. We'll go to the next slide. UK consumer confidence is within 1 point of its record low recorded during the financial crisis.
Yep.
And it's lower than the challenging points of the industrial strike action, all the other issues of the early 1980s. So people are really not happy about where things are going. And I mean, there was an article, I believe it may not have been the Financial, I think it was in the Times, the UK Times, that basically food and energy have been too cheap for generations and people need to get used to the change. Yeah, I think people are going to totally just buy into that, aren't they? Just accept that your cost of living is going to be smashed skyward beyond your control.
Well, it is true that as a share of total income, what people in the Western countries are paying for food has dropped dramatically over the last 3, 4, 5 decades. And there's a reason for that, of course. Globalization of supply chains, cheap food coming in from other countries around the world. So, but when you actually have been in receipt of that and have got used to it, suddenly, if you see your food bills doubling, which is what they'd need to do to get back to somewhere where it was previously, that's a big shock. At a time, of course, when the cost of everything else are going up and yet incomes aren't. So the consumer pressures are pretty dramatic. And, the consumer index in Australia is not looking that flash at the moment, although we're a bit behind the Northern Hemisphere. This is a fundamental structural shift, in my view, in terms of the way that people are thinking about the economy and what's important. And I think consumers, when they wake up from this nightmare, they might realise that the world has fundamentally changed, and not just temporarily, but permanently.
Yeah, and it's an unpleasant viewpoint, isn't it? There's nothing positive about it, and I mean, I think that something that's interesting in all of this is that you and I, we come on here, we talk about these things, and this is a sanitized viewpoint of what could come to pass.
Yep.
If you go on YouTube and you look at someone, say like Peter Zehan, or you go on Twitter and you read some of the stuff by the likes of Doomberg, who are well and truly experts on this stuff, and their theories may well and truly come to pass, it makes this look like Sesame Street.
Yep.
And that is just the most concerning thing, because our governments, our leaders are too busy faffing around talking about things that don't really matter, or arguing about things that are really just around the edges, rather than addressing these structural problems that could come and bite us in the ass really quite hard.
Yeah, and it's interesting, Tarric, that occasionally in our YouTube comments, we're regarded as, doomsayers or negative. I would say we're actually quite balanced in terms of trying to give the relativities of the upside and the downside, because you can find a lot worse if you don't look very hard.
Well, very true. And there's also the fact that we also have the benefit of us being right. I mean,
true too. Yeah.
People were saying, the Ukraine thing, that's not going to happen. We were talking about it the week before. I said, this is, if it's going to happen, this is when it's going to happen. It's well and truly on the table. And then boom, it was even worse than I said. So am I a doomsayer for predicting it? Or am I not a big enough doomsayer for not saying that it would be the absolute disaster that it is for Ukraine and the world?
No, and I guess what we try to do is to avoid the the really flowery language and everything is doom all the time, right? Because what we're trying to do is get nuanced, but anybody with half a brain can see that some of these things were actually there and we're going to come through. So the fact is that we're just looking at the data and drawing our conclusions from it. And as you say, we've had the tendency to actually read it pretty right.
Yeah. Okay. I mean, we are the kinds of people. Did we get certain things wrong? Absolutely. Mea culpa. But by the same token, we're not paid analysts earning 6 or 7 figures. We're two blokes on YouTube who get paid absolutely nothing for this.
Correct.
So maybe just take it all with a pinch of salt. Might come to your own conclusions, but I think that we provide a bit of valuable insight here, and if I do say so myself, which I do.
Well, I reckon it's the charts and the shirt.
Well, yeah. Well, maybe I should bring back the other blue shirt. That seemed to do well with the ratings. Okay, now this is a bit of the butterfly effect in action. Now, as some of you may know, Ukraine is one of the biggest suppliers of sunflowers and therefore sunflower oil. I believe it's the biggest in the world. But now there are obviously other kinds of vegetable oil. So, for example, palm oil, which Indonesia has recently banned the export of, because they want to ensure that prices are kept low for families and businesses in their own country, which is perfectly understandable from their perspective. But it's also having the impact of sending the price of vegetable oil globally to the moon. So this is the type of butterfly effect that we've been talking about now for a while, whereby a country attempts to look after its own populace first and foremost, but then that has the butterfly effect of sending the price skyward for literally everyone else in the world, which then impacts inflation, which then causes more social problems in the other countries who are then impacted by it, which then forces more action from those governments, or if they don't have the money for action, potentially in time contributes to social unrest. So there's that negative feedback loop there for as long that the potential, I should say, for that negative feedback loop there, for as long as the conflict in Ukraine continues, and for as long as these global pressures on food and everything else continues.
And I was listening to somebody talking about a very good example. So in the UK, a particular manufacturer of prepackaged oven chips switched from palm oil to sunflower oil because it was environmentally more sustainable and sensible, right? They did a few years ago. And they've now had to come out and say, well, actually, we've got to go back to the palm oil because we can't get the sunflower oil, right? So not only are you actually going back and putting the price up because those oils are going up as well. But they're also now, from an environmental perspective, compromising on their original principles, which was to move away from palm oil because of its environmental devastation. The butterfly effect has big wings.
It does indeed, and this is just one example of that so far. I mean, another one of the big ones that I previously mentioned was the impact of fertilizer bans. The world's two largest exporters of fertilizer are Russia and China. Russia and China have both banned the exports of fertilizer to varying degrees. So, these problems are not just going to go away. I mean, in reality, they're being baked in to the pie, so to speak, as we right now, because the cost that a farmer has now that they're going out, they're fertilizing their field, they're doing what farmers do. I won't go into too much detail, but those crops aren't going to be harvested for months.
That's right.
And then they're going to be passed through to consumers, and then those prices are going to be passed on to consumers as well. So all this stuff is being baked in, and that's why I just find the whole idea of, people talking about, peak inflation. That's something that matters to the market. To the average person, they're not really going to care if inflation is 5.5% or 7.5%, if their cost of food is rocketing, if their cost of energy is rocketing. That's what's going to matter to people. Whether an iPhone is more expensive or not doesn't really matter in the grand scheme of things.
No, well, you put iPhone in the discretionary spending category, whereas food, of course, is non-discretionary. It's interesting, a lot of supermarket chains around the world are now signaling very strong food price growth over the next few months and years. So this is embedded again, going back to what we said earlier on. This is an embedded problem. This is not going to go away quick. So all of that rubbish about, inflation will disappear, in a few weeks or a few months, I don't think it will.
We are seeing the beginning of deflationary trends in places. Say, for example, in US trucking, the cost of transportation via truck is now plummeting because the number of because basically inventories have started to rise to very, very high levels, and basically the trucking industry has adapted, and now you're starting to see prices fall. So that is, in essence, that is deflationary, but it's only one part. You are going to see deflationary forces, you're going to see inflationary forces, but it's about how they balance out in the end. And while for the longest time I was very much in the deflation camp, you've just got to look at these changes that have occurred within the global market. And yes, there are going to be deflationary forces. There may even be periods of deflation, but the inflationary outlook in terms of the long term has changed because of the war, because of lockdowns, because of the end of just in time logistics. There's all these different things that are shifting it to a more inflationary future, and there is the risk ahead of an inflationary feedback loop. Regardless of what the catalyst may be, whether it's a EU ban on Russian oil or whether it's something that just occurs organically.
I think I agree with that, although I would add that for me, I'm looking at the debt trends, right? Because the other force of deflation will be affected the unwinding of debt. So we've had a huge growth in debt over the last, 20, 30 years, driven obviously by quantitative easing and very easy lending standards. But with interest rates rising, and with corporates now effectively having to pay a lot more for their funding, it seems to me it's quite likely that we could actually be in the situation where lending growth stalls and total debt could actually go into decline. Now, that in itself would be an extremely deflationary element, bearing in mind, of course, that a lot of the inflationary pressures are driven directly or indirectly by debt.
Indeed, and then that's the thing. If you do see that type of, really, that's a massive recession. Yep. If you see credit reverse, it's a massive recession and or depression. If credit reverses, because we live in a credit driven economy. Say like mortgage credit in Australia last year was what, 10%, north of 10%.
Yeah.
So you can't just, if you take that away, the system starts to have some rather serious issues. So if we have a crisis like that, yeah, I agree with you. You're going to have some fairly major deflationary forces. And to be completely honest, I don't know what would happen in that regard. How all that balances out in that type of crisis, that's pretty much unheard of.
Well, the only answer is that you'd actually then find that the central banks have to take rates lower again and throw more quantitative easing onto the fire, trying to recover it. And by the way, that would also break the stock market and the other markets too there. So my point is, we are in the situation where we've got inflationary and deflationary forces interacting with each other, and I'm not sure anybody can figure out who's going to win in that tussle at the moment.
No. I mean, I think that, yeah, I mean, the thing is, there's so much that could happen in that regard. You could see, some form of, permanent shift as a result of what's going on with Russia and Ukraine. And that could completely just blow the whole thing wide open. So, it's really quite challenging in that regard. And I mean, and not only that, but there are other, sort of doomsday scenarios, things like a Chinese invasion of Taiwan and all that sort of stuff, which, are possibilities.
Yeah.
And if they were to happen, then it's open season, and no one knows what's going to happen then.
Exactly right. Uncertainty.
Yeah, well, that's the word of the year, or perhaps even the decade. Okay, now this is what I was referring to earlier. The Japanese central bank has been trying to cap the 10-year Japanese bond yield at 0.25%. They have offered to buy an unlimited number of bonds at this level in order to keep it capped, to basically prevent yields from rising higher than that. Now, if some of you may remember that the RBA tried to do that with the Australian 3-year bond, and they did that successfully for a while until such time as it blew up in their face and yields went about 7, maybe even 8 times. I think it was somewhere between 7 and 8 times higher than where it was. Now, if that happens to the Japanese, they've got some fairly major issues, but the Bank of Japan is not the RBA. As a result of them trying to do this, the Japanese yen, the value of their currency, has dropped to a 20-year low, and there is concerns that there could be even greater downside ahead.
It is interesting, isn't it, watching the interaction of central bank intervention and the exchange rate. And I suppose you could argue that, well, the exchange rate is meant to be a bit of a cushion, right? So, you pull the levers one way and the exchange rate moves the other way. But the consequences of these movements in exchange rates have huge real-life implications for, cost of goods, inflation, and all sorts of other things. There's no zero-sum game in this.
No, there isn't. And I know there is the argument that Japan is an export nation, that as an exporter, a weaker currency is a good thing. Now, that may have been true in the past, and it may still today be true to a certain degree. But Japan has been running persistent trade deficits recently, and it doesn't benefit them as much as it used to. And part of the problem for Japan as well is that their consumers and their households are balanced on a much, much finer knife edge than in the rest of the developed world. If they start to see in big, large levels of inflation, their consumers are not going to be able to cope as well as consumers in the US or consumers in Australia, or even to a lesser extent in the more prosperous parts of Europe, if inflation was, say, 3%. 3% inflation for Japanese consumers is actually a fairly significant challenge. So that's something that they've really, really want to avoid. And that's, as I said earlier, that's something that the Japanese finance minister and the Japanese government is very, very concerned about.
Absolutely. And it's just worth underscoring the demographic shifts in Japan, because they have this huge bulge of older people going through. So their productivity and the ability to be able to actually service those older groups of people are getting more and more difficult. So there is an underlying structural or demographic issue here, as well as the exchange rate issue. I actually think some of those things are connected, by the way.
No, I agree, and that's part of the problem as well for the Japanese government, because for the pensioners, they're going to be the ones who get hit the hardest by the weakening yen. So, and a lot of them don't really have the room in their household budgets to be able to start paying more for things. And That's why price stability is such a premium in Japan, and unlike in the West where it's all about profit, 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 price stability is something that's prized even by Japanese companies,
Yep.
because they know that well, one, it gets them a pat on the back, and two, that it helps retain their consumer base. But if they've got to start jacking up their prices significantly, that's going to sort of break that social contract that exists in Japan.
Yeah, absolutely.
This is the Philadelphia Fed's Manufacturing Business Outlook survey, and it's another chart that really speaks for itself. You're looking at the lowest levels since 2011, and pretty consistent with where things were during the financial crisis. So, it put simply, the outlook's not that great. We're still seeing decent numbers in the US GDP figures. They may even be relatively decent for another quarter, based on basically the largest expansion in US consumer credit in history. But in terms of the longer term view, it doesn't look good.
No, absolutely. And, it's worth just reflecting that, the Business Outlook survey is relatively sophisticated. It tries to put a number of different elements together, right? So it actually does have a reasonably good handle on what's going on, and a bit of a track record of being relatively right. So this significant fall, to my mind, is very concerning, because it really is a forward-leading indicator.
Yeah, and there are quite a few other leading indicators pointing in this direction.
Yeah.
Like there's still that level of hubris present there in the US economy, which you'd think there wouldn't be, considering that the headline GDP figures got absolutely hammered. But we'll get to that in the next slide. Okay, now GDP is not the best measure of economic activity in the world. Well, okay, maybe it is, maybe it isn't, but it's not really all that useful at times. Let's just put it that way. And basically, what happened for the US overnight with their GDP figures, as you can see on the right there, is that net exports detracted 3.2%. Now, this is an annualized figure because the Americans do that for some inexplicable reason. Net exports detracted 3.2% from US GDP for the first quarter. Now, that's because basically America imported a lot more than it exported in relative terms. Now, I think that that little nugget is particularly interesting because it shows that while US domestic demand, I should say, is holding up relatively okay for the moment, arguably on the back of the expansion in consumer credit that I mentioned, the rest of the world is struggling. Imports are falling off. So even if, hypothetically, you did see US imports continue to strongly rise for whatever reason, and you saw exports to the rest of the world continue to drop off because China's in lockdown, because people in Europe are concerned, their confidence has collapsed, for example. If you start to see those things dropping off, then you've got, ironically, the recipe for another bad GDP print. Because if you do see that big gap, that gap widen between imports and exports, that's going to potentially, drive down the Q2 GDP figure, and the US could enter a recession. Whether it's going to feel like a recession in terms of the level of consumer spending, that's another question entirely. But that's the mystery, shall we say, and the in some cases, some people call it the voodoo of GDP.
Yes.
That scenario is well and truly on the table, and could well create a US recession. They could technically be in a recession right now.
Yeah, and it's just worth reminding people, GDP is a measure of activity, all activity, right? So whether it's gun running or prostitution or building houses or whatever it is, right? It all is all counted the same. The other point, though, it's interesting that some of the commentators said, well, this weak GDP number is good news because it means that the Fed won't need to lift rates so much. So, silver lining, well, I don't know. It seems to me that it'll be very interesting to see whether they actually do temper their plans based on the GDP. By the way, it often gets revised later, and it could change again. But another sign of concern, at least.
It is, and and in this last slide for the day, I just think it's an interesting last one to conclude with, because The US really is well, it's the last remaining engine of global growth. China is in lockdown. They are going to, struggle over the next few quarters. Europe is a basket case because it's got to cut itself off from Russian energy exports if well, it doesn't have to, but it's choosing to. And they already had some problems before this. The developing world has got some rather significant issues with inflation. So the US is the driver of global growth.
Mm.
So if they go down, they're dragging the rest of us down with them. So I think it's going to be interesting to see how all this ends up playing out in the end, because I don't think that the Fed is going to change tack as much as the market hopes, because the bond market didn't react at all to last night's data in terms of pricing and rate rises. As far as it's concerned, it's still full steam ahead. What I think it's about 175 basis points over the next 3 Fed meetings. So, if that happens, well, it's going to get interesting.
Yeah, and the Fed, of course, was already behind the 8 ball when it came to dealing with inflation. If they would have then pedaled back on their recent comments, because, of course, a lot of the Fed officials have been setting up the market to expect at least a 50 basis point hike next week, right? If they were to hook that now, I think their credibility will be even more shot than it currently is, and it's pretty shot in my book already.
No, exactly, it is, and that's the thing, like people are saying, oh, but if the market goes to X, the market goes to Y, unless you start to see the issues within the bond market, unless you start to see, what does the Fed like to call it? The disorderly, the market becoming disorderly. If we just see an orderly grind down in the market over the next, 6, 9, 12 months, I don't think there's much incentive for the Fed to intervene there. As long as they haven't broken anything major, I don't really see any reason that they can't just keep hiking rates to their heart's content, because at the end of the day, that is what may be required to break the back of inflation, particularly if we do start to continue to see inflation flowing in from the rest of the world.
Well, Powell is, quite clear that inflation is now right there at the centre of his strategies. We will use all our tools, which is one of his favourite sayings, of course. And I agree with you. I don't think that if markets start to slide, that's going to actually trigger the Fed put. There are still a lot of market participants who really do truly believe that the Fed won't allow markets to fall. But when the prize is trying to get inflation under control, which is what they're mandated to do, something's got to give. And markets is, well, that's the obvious place, really.
Well, I think you've got the title for our next show right there. Something's got to give. You're absolutely right. They can't have it. I mean, realistically, inflation is going to remain elevated for the rest of the year on a year-on-year basis. Even if month on month it ends up slowing down significantly for whatever reason, whether it's deflationary forces from trucking or whatever, we're still probably going to end the year with inflation, 4-5% minimum. So that's a problem. That is a rather significant issue. They can't turn around with inflation at 4.5 or 5% and just go, oh, we're going to start QE again and start cutting interest rates and inject even more cash into the economy. It's like, but inflation's at 5%. You can't do that. Yes. It'd be political suicide. I mean, and not only that, but I think there's also going to be quite a lot of pressure on the Fed politically, because this is, I mean, admittedly, it's not entirely their fault. There's more than enough blame to go around for fiscal policymakers and everybody else. But this is of the Fed's making. Things didn't need to be like this. There didn't need to be this level of systemic risk within markets. They could have easily reflated the market, done it a bit more gently, come out very explicitly and say, you're on your own. No more of this softly, we're all going to get made whole bullcrap. Just say, this is normal market conditions resuming. We're pulling back on QE much, much earlier because we don't need it, and et cetera, et cetera. They could have done all those different things to minimize the levels of systemic risk, but no, we've got to send the S&P 500 to 4,800, and we've got to send junk bond yields to the basement because reasons.
Yeah, and it's just worth, as we come to the end of our show, highlighting this. If anybody thinks that all of these issues that we're now seeing have been created because of COVID or because of the Ukraine-Russian conflict or even the price of oil, right? It's important to understand that the seeds were laid at least a decade ago, back through the global financial crisis, when central banks decided that they were going to actually not allow markets to fall and would actually always be there, and all of those things. We are now beginning to reap the whirlwind of 15 years of bad central bank strategy, right? And central banks around the world all smoked the same dope and all did the same stuff. That's now the point. We're now at the point where this is now crystallizing out. And let me just be clear. When you create billions and billions of extra dollars chasing the same amount of goods and services, you're going to get inflation, right? When you actually underwrite cheap lending to businesses to allow them to buy back shares to make the share prices go higher, debt rises. So big debt, big liquidity, inflation. These were things were created. The monster was created by central banks a decade ago plus. And that means that we are in for not just a little sort of tweak here, right? This is actually now a really critical point in history when the role of central banks, in my view, going ahead, should be questioned because they've stuffed us up. Yeah,
I mean, I liked the bit about the more smoking the same dope. That was a good one. You might have to make some t-shirts. No, I mean, I'm forced to agree. And I mean, the problem at this point is that we are literally looking at a situation where if they don't do the right thing, where if they don't if they don't fight inflation, if they don't focus on that issue, if they instead fall back into old habits of protecting the market, you're talking about absolutely disastrous consequences, for people around the world. I mean, people in the developing world are paying for the sins of the West's leaders, of the West's central banks.
Yep.
They are paying, in the form of social unrest. They are paying in the form of higher prices. And if the Fed or anyone else thinks that they can just suddenly go back and start and refill the punch bowl and go back to the way things were, while inflation is still a major factor, they are going to start blowing up countries around the world. And they are going to severely undermine social cohesion and social stability in our own nations, because people are not going to be happy, when the rich are getting richer and we're all getting smashed by higher prices at the grocery store or at the petrol pump, just because some rich person wants the value of their asset portfolio to remain high. That's not going to work. Now, I'm not saying that they won't do it. They may very well do it. It would be one of the dumbest decisions in all of human history, but it's well and truly, unfortunately, on the table because it's consistent with the last 15 years of their idiocy.
Exactly right. Central banks, yeah. Well, there should be a bit of an inquiry about whether we need central banks at all, right? Because they seem to have completely shot the bolt in terms of credibility and in terms of actually dealing with the issues. And I reminded you again that the Reserve Bank, their recent Senate inquiry said, well, we've got new information, it wasn't foreseeable. None of this was foreseeable. And I'm thinking, yeah, well, I don't know. It's pretty foreseeable to me. Tarric, I really appreciate your time today. I noticed your little trick, by the way, of solving your slide problem by having 2 slides on pretty much every slide. That's a very neat way of doing it.
Oh, you saw through my sneaky little plot, did you? Yeah.
I reckon you've been following the Reserve Bank and found a way round.
Oh well, I have to, mate. There's so many slides. There's literally like another 35 I didn't use.
Well, thank you very much. Links below for those who want to get hold of the original slides. And once again, Tarric, really appreciate your time. We'll do it all again soon, hey, because there'll be more to talk about.
Unfortunately, there will. I'll see you then, mate.
Take care. Bye-bye.